Hey everyone, it's Imran from Options Insight, back with another macro options spotlight.
Remember, like, subscribe, comment, ask questions. We want to get this stuff passed around so more people learn about options.
Okay, looking at markets, US stocks continue to be punished after the long weekend as those long end yields are pushing even higher, very, very close to 4% on the 10-year now. Terminal rates also pushing up to cycle highs at 535. Europe and China did lag the sell-off, but they are still weak as risk asset weakness just kind of spreads around. And then looking at commodities, they did slide lower with natural gas down 7%, uranium down 4%, all the other commodities kind of heavy, but silver and copper in the green, with copper staging a nice 3% bounce there. So for now, copper really remaining the most resilient within the commodity complex. If we look at volatility, implied vols really exploded in the US. So we've been flagging this fragility that's been building in US options markets, and it does seem to be fueling a bit of a bid to options. So we saw S&P vols up 2, Russell vols up 4. We had flagged Russell as your best candidate for put buying a week or two ago. Hopefully some of you got those Russell puts on board, but definitely seeing a nice little explosion in volatility there as that Russell was down 3% on the day, nearly a 2 sigma move. Now, if we look at other asset classes, the dollar, surprisingly, is just grinding higher. It's failing to really accelerate despite the moves in yields and despite the moves in risk assets. So that's a little surprising to me. I would have expected the dollar to pick up a bit more velocity on the upside, but for now, not happening. If we look at dollar yen, it's at 135. Keep an eye on that thing. That's obviously very correlated to what yields are doing. Yields have been going up. That thing's been grinding up, right? But at some point, if you think yields are topped out, then dollar yen's going to look like a great short here, because you might also have the Bank of Japan giving you a tailwind if they're going to exit that policy. So keep an eye out for entry points to get short dollar yen if and when you think the yield story is kind of done. Outside of that, GBP, the pound also popping on better PMI data out of the UK. Obviously, quite a big consensus that the UK economy is in a bit of trouble. So the fact that they came out with better PMIs was a knee-jerk reaction to the upside in sterling. Treasuries getting whacked 2%. High yield bonds, HYG getting back whacked 1.5%. Those are like 2 sigma moves. Bonds really taking a shoeing yesterday and getting repriced. And we're seeing bond volatility up, best part of 2 vols as well. So really seeing some action there. That move index that had been coming down for a while, lulling investors into a false sense of security, has reversed pretty sharply and is kind of taking the entire risk asset complex with it right now. Okay, now we talked about a window of weakness post OPEX last week. We had a chat with our good friend Brent at Spot Gamma. People were asking us on that call. I encourage everyone to join those live calls once a month to talk to me and Brent and see what we're thinking. But we said that, after OPEX rolled off, any support that was coming from the Vanna and Charm flow of those puts in February that were expiring, that support was going to get taken out, and we may get a window of weakness. So that does seem to be materializing right now. Now, I did say that the reason why, obviously sometimes when the gamma expires and there's a bit of an unclenching of the market post OPEX, markets can go either way. But the reality was that macro was deteriorating, rates were moving, and equities were just ignoring it because there was this bid coming from the fact that dealers were unwinding short. Once that bid gets removed, equities can reprice to the macro landscape, and the macro landscape has only been going one way, with yields pushing higher. So that's why we thought a catch down trade was very possible. I did say I didn't think 3,900 would break. So we are heading down there. We've broken this key volatility trigger at 40.60 that Spot Gamma have been looking at. And we found some support at that key 4,000 level, which has got a ton of open interest there. So we do still think the put wall at 3,900 is at risk of being tested. If that level is going to hold, we're going to be looking to see unwinds and monetization of puts as we go down there. There was a big March 39.50 put that traded. Apparently Carl Icahn bought that as well. Be interesting to see if he looks to monetize that if markets do head below that strike and go down to 3,900. But that's what you need to see. You need to see dealers, these short positions that dealers have got down here, you want to see those coming back to more neutral as the clients who have bought all that downside monetize it and sell it back to dealers and get the dealers' books a little bit closer to home if you're going to see a support at those levels. But I would look for 3,900 on the first test to hold. For now, we're battling around 4,000. But if we were to break lower, I would be looking for 3,900 to find some support as well. And then bond markets have been leading equities lower all month. Price action in HYG, which has been one of our preferred shorts. Subscribers to our overlay product will know that we've got some June HYG puts in the book. And we were just of the opinion that HYG would find it hard to squeeze. Equities, have a tendency to squeeze a bit more on the upside as people kind of YOLO into stocks and things like that, most shorted names. We just thought HYG was going to be more anchored to the real story that was going on in markets, whether it's QT, whether it's oncoming recession and high yield credit spreads just not being high enough. So we thought that HYG was going to make sense to be short, and it seems to be leading on the way down. So we still think that high yield spreads will likely go higher as we head into the summer. If the labor market starts to crack, if the recession scenario comes back, we do think these a retest of those lows that we saw in September, October last year is fairly likely, and we may even take those lows out in HYG. So still kind of holding that view for now. Okay, now looking at bonds versus equity, that seems to be, the thing on people's radar right now. If we were, last year, obviously bond markets had a shocker. Investors came in a bit more optimistic on bonds this year, given that a recession had become a bit of a consensus. But this month's risk asset weakness has once again been led by bonds, which have underperformed stocks. So here we can see the S&P, whilst it has come down, bonds have come down. This is TLT. Bonds have come down a hell of a lot more. So we do think there's a bit of a catch up still potentially in equities. A good way of measuring that is this equity risk premium. So you can see the equity risk premium has collapsed because bond yields have gone up and S&P hasn't sold off enough. Therefore, dividend yields look relatively, earnings yields look relatively good in equities. So we do think there is potential. Whilst bonds might still have room to go lower, we think equities have got a lot more room to go lower, right? As there's just not that much priced in to equities yet. So we're looking for relative value opportunities to play a bit of a catch-up trade where stocks will start to underperform bonds, given that bonds have sold off so much and the fact that yields have kind of come all the way back up to 4%. So what sort of trades make sense? So when we look for relative value, we go to our trusty cross-asset volatility and skew matrix. This kind of helps us identify where vol and skew is across all these different assets. And what we've seen is a general drift in this direction where volatility and skew have been rising, particularly for the equity landscape, right? So you can see all these green dots are European and US equity indices. They've been heading in that way. Now, TLT has also risen in vol terms. So you can see TLT and S&P vol are pretty much equal here. But the problem is, if we were looking to buy puts on S&P and sell puts on TLT, it's not just the implied vol at 20 that matters. It's also the skew. And because the skew is so much higher in stocks, it basically means that we'd be paying a higher volatility for S&P puts, which are on the downside, than the vol we'd be getting back for selling TLT puts, which are on the downside. So how do we kind of neutralize this impact of a more expensive skew in equities versus bonds? So to do that, we would use put spreads instead of puts. So the trade that we're looking at today, all right, that's the trade for today. Thanks as always for listening. I'll catch you tomorrow. Cheers.